and welcome. You tuned into Rush Hour with me, Ankita Saxena. Well, the big news coming in right now is that the European Central Bank has again raised the main referencing rates by 25 basis points, taking it to 4%. The central bank has raised the base rates by 3.5% since June last year. Now taking it to record highs. Now this comes after the inflationary pressure increased in the region in the past months, which is seen to be averaging to 5.6% in the current calendar year. Now ECB has cut growth projections for all years till 2025. Here's what we got from ECB's President Christine Lagarde. Let's take a look.
Inflation continues to decline, but is still expected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. In order to reinforce progress towards our target, the Governing Council today decided to raise the three key ECB interest rates by 25 basis points. The rate increase today reflects our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The September ECB staff macroeconomic projections for the euro area see average inflation at 5.6% in 23, 3.2% in 24, and 2.1% in 2025.
Well, that's the word coming in from the ECB President Christine Lagarde. But how will this impact the markets and the global economy? To discuss this, I have with me Anurag Singh, who's the managing partner at Ansid Capital. Welcome to Rush Hour, Anurag. Anurag, first up, the European Central Bank has opted to increase the rates by 25 basis points. This is delivering the 10th consecutive hike, and it has taken the main rate to now 4%. And the markets were pretty divided on this. There was a 50% consensus believing that, the ECB could be pausing the rates, but clearly it didn't. So has this firstly come as a surprise? And also because clearly now the inflation risk is outweighing the gloomy economic outlook.
Hi, so I don't think it actually surprises the market so much. Market was expecting there was a 65% probability that ECB would hike the rates. So, that's as close to 50-50. So I think ECB is probably at a similar point where the Federal Reserve is or was, which is that they feel that they have hiked reasonable enough to play it out for the next 18 months. And any further hike should be incremental, should be very data dependent. And I think that's what ECB has done. So they've got to this kind of a round number at 4%. But I think we have to see this in the context that ECB is a collective set of multiple countries. There are many countries now. We see only the median number or the mean number, but then there are many countries which are doing well below this number. So ECB has to balance all of these requirements. And so that's where I think ECB is signaling that probably we have reached a point where we can probably pause and wait for it to play out. Also understand ECB is just a one-mandate bank. It only controls inflation. And it doesn't really look at unemployment, but doesn't mean that it can ignore it. So I think we've reached a point where probably also Federal Reserve in US is that they want to wait and watch. It's still not restrictive enough, but if you look at certain countries in ECB, it is restrictive enough. That's a quick take.
Right. Anurag, so the economic growth, in the Eurozone is set to slow down. It is set to slow down to 0.8% this year and 1.3% in 2024. Now, that's what the European Commission said on Monday in its updated forecast. And now that is a downward revision of, 0.3 percentage points, compared with the May estimates. Now, the ECB has also cut the growth forecast, in every year through 2025 now. Is that a signal for the ECB, to keep the rates stable going forward? Is that a signal now?
No, it's I would say the rate revisions are normal because look, think of it like this: what would happen if RBI comes out and lowers the economy rate growth of economy projections drastically downwards or upwards, right? It creates an alarm in the market. So that's understandable that ECB is just following the trends and kind of not being alarmist about it. But I think, yeah, last week, I think lowering the growth targets to 0.8% for 2023 and 1.3%, just a 20 to 25 basis point drop. I think that's significant. That also send the signal to the markets that it is watching that there is a risk to growth, and ECB will not be aggressive or hawkish enough just looking at inflation that it just puts the entire eurozone into a recession. No central bank wants to do that, right? So and I think that's why we have to see this in combination. It's pretty obvious that Europe is struggling, one with a lot of energy and food inflation, but at the same time, a lot of services inflation. So I think this might take some time to settle down. I think if you look at their projections on inflation, they themselves are putting it out that inflation would get to 3.2% by the end of 2024, which tells us that they're themselves giving themselves about 12 to 18 months just to get to 3.2%, not even 2%, right? So it's a long battle, Sumita. We have to see it in this sense that it will take a little longer to play out.
Right. Also, Anurag, now the focus will shift to how ECB's President Lagarde frames the policy steps. So what are your expectations with regards to that?
Ankita, my apologies. First of all, I misquoted your name. But Ankita, can you please repeat the question? I missed it because there was a bit of a glitch in the moment.
Right. Anurag, what I asked was that, the focus will now shift to, how ECB's President Lagarde really frames the policy steps. What are your expectations?
Okay. So it is clear, Ankita, what we expect is that they will stay on a pause right now. They will be vigilant, which is exactly the language which Chair Powell quoted in the last meeting, which is that they don't want inflation to run out of control, but they know that it's gradually dropping. So they would just stay on pause. But they're not. Nobody is in a hurry to cut rate, right? So that's let this be out there. There are multiple views, I understand, about it, but even by the end of 2024, I don't see the central banks cutting the rates. But at the same time, they are also sensitive that they should not put the economy into recession by their aggressive steps. So I expect that this is probably the peak rate that European Union has reached at 4%. Unless there is some bad news on inflation front, they will probably persist at this and just kind of be in a hawkish pause. That's how I would call it, Ankita.
Right. Anurag, finally, one more question. Oil has been a point of concern. Oil has rebounded with Brent crude now topping the $93 a barrel for the first time this year. Now, oil market reports suggest tighter supply and higher prices through the rest of the year. And beyond that, they have been fueled by, the inflationary fears. Oil prices are likely to remain elevated. Let's just take it as it is. What is going to be then the impact on the inflation outlook?
Yeah, that's true. So, and I think this is where the pause comes into play, which is that there are multiple risks to this. So ultimately, we should not forget 2022, where headline inflation ran even 10% plus in Eurozone, all because of oil. And the economy can take an oil shock at maybe $80 to $90, but anything more than 100 and it starts creeping into other services and core goods inflation as well, right? And so that's why there is no scope for error here, because everything is, both the central banks are running a very tight ship, and oil certainly above 100 can spoil the party, and that's unknown, right? By the way, I must quote that all the central bankers look at the core inflation, which is net of food and energy prices. And in Eurozone, food and energy prices are also largely playing a play. But then we can't ignore the fact that the pocket of the consumer gets impacted by the overall headline inflation, right? So somewhere, but the assumption is that if the oil goes too high, consumers will cut back on spending on the core side as well. So it should not be damaging unless it reaches $100 per barrel, and and then it starts to trouble everyone. So I think a hawkish pause is the answer almost to everything, and being vigilant that if energy prices rise, it might demand further rate hikes, and that's the whole visual about it, Ankita.
All right, Anurag, thank you so much for joining us today.
Thank you.
Thank you.